My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate, teach. Call me at 1-800-743-CNBC or tweet me at Jim Cramer. Something strange happened when we turned the calendar to 2024. We kind of ran out of sellers. Sell, sell, sell. Now, before you call me an idiot when the market starts going down, let me just say I am approaching this thing retrospectively. I simply want you to understand how insanely different this market is from almost any other market I can recall. I'm talking about a total lack of analogies to anything I've ever seen. I've been prowling these canyons on Wall Street now for more than 40 years. Sure, today was a sedate session where the Dow advanced 141 points, S&P gained 0.23%, NASDAQ inched up 0.07%, really nothing going on. But keep in mind, there are so many reasons that we should be going down. The Federal Reserve brutally raised interest rates, something that should have crushed the economy. Normally, we'd be knee-deep in a recession with bankruptcies all over the place. Except we get one, Rite Aid. You'd expect companies to lay off tons of workers in order to stay solvent, right? Instead, highly profitable outlets like Amazon, Meta, or Spotify just fire people to boost their earnings, and it works. Meanwhile, higher rates did nothing to slow the rising cost of housing, principal locus, by the way, of inflation besides food, which also was immune to rate hikes, but not to Costco and Walmart. Oh, and by the way, congratulations to Rich Clancy, the longtime CFO of Costco, who's been more effective at holding down the costs for food for you than any central banker on earth, and he's now headed for retirement. Rich, we wish you the best of luck. In fact, housing's still up more than 35% in value since 2019, despite a doubling in mortgage rates. Now, that's not supposed to happen either. Normally, when rates go this high, you end up with a housing glut that only gets worse as the home builders are forced to cut prices in order to unload excess inventory. Well, we've still got a housing shortage, though. So the Fed's rate hike slowed the pace of inflation, but the cost of living remains much higher than it was before the pandemic, as we know from a frustrated McDonald's, which talked about prices being too high for many of its consumers. In other words, higher rates didn't bring out stock sellers, as they have every time, save for two short periods in the 90s. Or more likely, they may have brought out the sellers in 2022 and parts of 2023. But at this point, perhaps because the Fed's on hold with its next move to cut, the sellers have run out of ammo. Second, when you have a slowdown, you got a hedge fund playbook that says you got to dump the transport and the machinery stocks. They are supposed to be untouchable in this environment. But have you seen them lately? Led by the bedraggled United Parcels today, the whole group is on the move. Union Pacific and CSX at 52-week highs. JB Hunt, huge trucker. It's there, too. It's knocking on the door of an all-time high list. How the heck is that possible unless there's simply no one who wants to sell them that badly, or they're all owned by index funds? Or consider the case of machinery maker Caterpillar. If you go back to when it last reported, I made an impassioned defense of the stock right here, which we owned at that point for the Chapel Trust. I was in disbelief that people were selling Cat down at 208 because of some shadow boxing about inventory. The sellers were blitzing the darn thing, daylight precision, nighttime saturation bombing, you name it. And then the buyers overwhelmed the sellers as the stock rallied and then rallied and rallied from its lows. The shorts dug in their heels, but when we saw the earnings yesterday, they were fantastic, and we realized that Cat's business had been de-cyclicalized. Yeah, that's kind of like no more cyclical. Its biggest customers aren't China residential housing. They're oil and gas and data centers. America's the biggest maker of data centers and the biggest oil producer in the world, least exporter in the world. Both are growing by leaps and bounds. So the stock closed at 322 and change today, up from 208. Not bad. Third, we have what looked like a gigantic bubble going on in artificial intelligence. I've never seen an inflated and overstimulated concept. And I say that as someone who's believed in AI and generative AI all the way. And a champion NVIDIA as an own it, don't trade it stock for ages. The conventional wisdom said true believers in AI would eventually be left holding the bag as the whole house of cards collapsed. But it didn't happen. Sure, it still might. However, we've now seen a run in these stocks of biblical proportions. NVIDIA was at 210 a year ago. Now it's at 682. Supermicro, an adjacent player, is already up close to 140% just this year to date. AMD was at $83 a year ago. Now it's at $168. Ladies and gentlemen, these moves are simply insane. History says these AI stocks should have been obliterated by now. But what are you going to do with NVIDIA after it reports the largest upside surprise in history, a $4 billion blast to the upside? The upside No wonder anything connected with NVIDIA has been going bonkers. Then yesterday, just when you think it's all over, Goldman Sachs points out that the second half of the year could be incredibly strong for NVIDIA. Customers are nowhere near saturation. Why? Because Amazon, Meta, and Microsoft can't get enough of NVIDIA's chips. Hey, last month, Mark Zuckerberg from Meta talked about spending billions to buy 350,000 NVIDIA graphics cards. He'd like to buy more. So would virtually any company in the enterprise space. It wasn't even clear what he needed the stockpile for. It didn't seem to matter. It was viewed as smart for both sides. And now we're starting to hear of those chips being put to work. The nascent uses for generative AI are summations for quick reading of things you never get through, of course, without it. Real-time suggestions to people in call centers, or making it easier to fill out triplicate forms on loans, or how to calculate the cost of insurance down to the second, or the generation of stories, or the creation of digital storefronts for small businesses. That's just the beginning. In short, not only is AI not a bubble, the short sellers who bet against it, well, they just got steamrolled. I know big tech was down today, but I think they're just taking a breather after an unsustainably parabolic move. We have temporary swoons where money rotates to other sectors. Today it was the drugs and materials, two groups that rarely go up in tandem. But those rotations only tend to last a couple days. Oh, and I can't wait for those who describe Apple's Vision Pro as a non-needle-moving boutique product to get hoisted on their own AirPods. Fourth, the total chaos in Washington is not breeding sellers. Not. Nobody seems to care about the toxic nature of the Capitol or the inability to get anything done in Congress. We always say gridlock's good for the market, but that can be hard to remember at the moment. And we may have an immigration crisis at the border, but that's not a problem for the stock market. If anything, more immigration is good for the market because it brings down the cost of labor. Finally, China, it's become an unmitigated disaster. China used to be the growth engine in the world. Almost every company came over there and they got embedded in our system. But when things got terrible, the coziness ended. Sure enough, the American stocks with pathetic China exposure have all been hit. More on that later. Yet today, they're all coming back. Like China stopped mattering now that they're going to push sellers into some unknown way. We don't know what they're going to do. Now we have some outliers. Always do. The banks are reacting to the weakness in New York Community Bank Corp, which bit off a little bit more than they can chew and bought Signature, something regulators probably should have prevented, but they weren't doing their job. We know that the drug stocks are up today, but we've seen so many days that where you just had 3-day moves in the drug stocks, I don't trust them, other than Eli Lilly, which took a break today and reversed down nearly 40 points from its high. Tomorrow it can rebound. Oil's having a nice run, but that's because BP put up some good numbers, please. Too much of a glut there. So, the bottom line, last year we would have seen sellers coming out of the woodwork on all the moves I just mentioned, weighing if not knocking down stocks. Now, though, I think the short sellers have been obliterated, and almost everyone who wants to sell seems to have already gotten out. That's how you get such a strong stock market despite a not-so-hot environment. Perhaps only higher prices will produce the sellers that seem to have vanished, or maybe, just maybe, they've been vanquished. Let's take some calls. Let's go to Jeffrey in Massachusetts. Jeffrey.
Hey, Jim, what's going on, man?
Well, I don't know. I liked the action today. I liked it a lot. A lot of cool places. What's happening?
Not much, buddy. I'm just calling tonight because I need some help on Builder's First Source. I bought it at 29, and since then, it's shot up almost 500%. Can you give me advice on whether to hold on to it or
I was just telling my fantastic, unbelievable, incredibly staff, could we please get Builder's First Source on the show? I mean, this is just crushing me. Guys, listen to me. Dave, why don't you come on the show? I like your store. I've been to the new ones. They look terrific. Builder's First Source, you do not touch that one, Jeffrey, because that one is what we call an up stock. I think we should go to Ann in Indiana. Ann.
Okay, Jim, thanks. I'm a club member, thank you, but I need a lifeline. I just feel confused lately, and one of the things I feel confused about, you had talked about consumer or enterprise stocks at this stage of the game.
Right.
So I'm a little concerned about Stanley Black & Decker, or do I just have to be patient?
Okay, this is just a great question from a club member, and thank you so much. We're looking forward to seeing all the club members for our meeting. Here's the problem with Stanley Black & Decker. It's the one stock we have that needs rate cuts. We decided to have one that needed rate cuts, so if we get rate cuts, the thing goes to 120. This one is going to mark time and until we get the rate cuts, so don't mind. It's just what has to happen. Last year, we would have had sellers all over the place, given the environment, the checklist I gave you. But now I think most short sellers have been obliterated. And anyone else, I mean, I don't know who's left to sell other than index funds. Mad Money tonight. Ever since interest rates peaked in October, stocks like Simon Property Group have been able to make a comeback. So what should you make of the high-end mall owner and operator up here? Don't miss my exclusive with the CEO. Very rare. Then Cramer fave Chipotle reported after the bell, and I'm running through all the headlines from the quarter with the company's top brands. And after a mixed quarter this morning, what should you make of Carrier Global as the company continues to make some major portfolio changes? I'm checking in with the CEO, so stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.